inventoriable cost. So the costs are transferred. Normal costing assigns cost to the product based on historical average cost, which may be different from the current actual or expected cost. Actual costing attempt to assign cost to specific product or batches based on the cost of resources actually used. Due to fluctuation or permanent changes, actual cost may be different from normal or expected cost. Now, how to account byproduct? There are two methods. One is the production method. It recognizes byproduct inventory as it is created and sales and cost at the time of sale. Sales method. It recognizes no byproduct inventory and recognizes only sales at the time of sales. Byproduct costs are not tracked separately. So, in the previous case, they tracked separately. In the second case, it is not. Now, one more major budgeting is the capital budgeting, that is related to the generally the capital equipments. Capital budgeting is a decision situation where large funds are committed in the initial stage of the project and the returns are expected over a long period of time. These decisions are related to allocation of investable funds to different long-term assets. Capital budgeting is a continuous process and it is carried out by different functional areas of management such as production, marketing, engineering, financial management, etc. Now, these are the basic features. Capital budgeting decisions have long-term implication. These decisions involve substantial commitment of the fund. These decisions are irreversible and require analysis of the minute detail. These decisions determine and affect the future growth of the firm. This is carried out by three steps: estimation of the cost and benefit of a proposal or of each alternative available, estimation of the required rate of return, what is the expectation of the investor, the cost of the capital. Depends the composition of cost, because cost is generally either equity plus debt plus derivatives and debt instrument. Selection and applying the decision criterion. The cost and benefit for a capital budgeting decision situation are measured in terms of cash flows. There are different methods which is used. The ordinary cash flow ignore the inflation value. Then there are scientific process where the inflation is undertaken and where the NPV or discounted cash flow statements are prepared. An important point is that all cash flow are considered on after tax basis. The rule is that all financial decisions are subservient to the tax laws. So, the charge of the owner or dividend to the equity holder can only be paid once the tax is paid. Therefore, the cash flow is subservient to the tax law. The cash flow from the project are compared with the cost of acquiring the project. It should always be the higher. Now, these are the relevant cash flows. Cost of the new project, scrap value of the old and new plant, it is estimated, and the time is also estimated when the project will go to the scrap. Trade-in value of the old plant, what are the cost reduction if you implement the project, effect on tax liability, because it is possible that by choosing a particular process or particular equipment or equipment from a particular source may give you benefit in taxation. Incremental repairs, working capital flows, because different process require different operational cost. Revenue from new proposal, tax benefit of incremental depreciation, because depending upon the tax rate in which class your asset fall, you will be able to get benefit of depreciation that will reduce your tax. These are the irrelevant cash flow. Sunk cost, because it is historical, there is no sense in controlling it. Allocated overhead, because this is not the actual cost. This is merely allocation process and financial cash flow. So, these are the generally initial out cash flow when the project is started. Cost of the new plant, it include transportation, transit insurance, loading and uploading expenses, installation expenses, other capital expenditure, say for example foundation, building, welding, etc. Question from Amit. How will the Singur case of Tata affect balance sheet and budgeting of data? Okay. So, the question is related to the nano car project which is shifted from Singur to Ahmedabad. So, expenses related to this transfer of project all expenses will be absorbed by the organization. So far as the financial accounting is concerned, it is a loss, it is an expense. But so far as the cost accounting is concerned, cost accounting only undertake those costs which customer can reliably absorb. So this cost is abnormal cost. So generally customer only agree for the normal cost. So transferring cost for the accounting purpose, financial accounting, all cost will be recorded as an expense. But at the same time, for the costing purpose, this transferring cost will not add value, add cost to the unit, that is nano car. The reason is, principally the customer only pay the normal cost. Say for example, if you manufacture ice cream, you require milk as a raw material, which is generally available in the city where you manufacture ice cream, or in the district in which you manufacture ice cream. So that is the normal cost. But you import milk when your manufacturing unit is in Indore, and if you import milk from Middle East or USA, obviously the cost of milk and transportation will be too high, and therefore your customer will not ready to pay those abnormal expenses. So financial accounting will absorb all transferring costs Tata has to incur, but for costing purpose that will be ignored. The reason is very basic, that customer does not pay abnormal cost. Plus additional working capital or cost related to additional working capital minus tax benefit on account of capital loss on sale of old plant, if there is a capital loss which is incurred. For your information, if there is a capital loss, then that will reduce your income tax liability, because the past year's profit or future year's profit may be set off against the capital loss, minus salvage value of the old plant, plus tax liability on account of capital gain. It is possible that you may have some capital gain. In that case, you have to pay tax, and if there is a capital loss, then that will absorb income of your business as such, and therefore your income tax liability will be reduced. Subsequent annual cash flow, profit after tax, plus depreciation, plus financial charges multiplied by 1 minus tax rate, because financial charges are deductible expense, and therefore that will reduce your tax liability. Therefore 1 minus T. Repair if any, capital expenditure if any. Question from Shaji: how additional working capital outflow comes okay? So additional capital outflow, because working capital is generally positive,